G'day, I'm John Dazley from CMK Accountants. Today I want to walk you through the fixed milk price options and how they relate to a dairy farm and how they can give you a bit more stability so you know exactly what income you're going to get year on year. Look, fixed milk price options, as I mentioned before, is a way of managing milk price volatility and also a way for you to essentially control what your income is going to be and have a real good idea and with a bit more certainty of what your income is going to be throughout any season. Payout volatility is a major challenge for everyone in the dairy industry, as you all know. Fluctuating global dairy prices impacts your income on a day-to-day basis, and we are actually at the mercy of the market, and hence it does affect your cash flow quite significantly. So risk management strategies like milk price hedging provide income certainty and allows the farmer to have better control of their business and also to plan more efficiently. So what is milk price hedging? Hedging is a risk management tool that allows farmers to lock in for a price a portion of your milk. This helps you to reduce the impact of market fluctuations, and it also improves your financial planning and gives the farmer certainty. But how does it work? Fonterra and Open Country and many of the other smaller dairy companies around the country do offer fixed milk price options. Farmers can apply on a monthly basis, as it is with Fonterra. There's 10 of them a year on a portion of their production, and ensures that you are guaranteed a payout for part of that production. As in last month, $9.63 was the offer from Fonterra, less a 10-cent premium for that. So Fonterra's fixed milk price program, there's pretty much 10 applications open each year from March to December. As I mentioned before, the latest one from Fonterra was at $9.63 gross, less a 10-cent margin. You can lock in up to 50% of your estimated seasonal production can be secured through this. And how it works is the fixed milk price is greater than the farm gate price, then a top-up will be paid to the farmer in September. If the fixed milk price is less than the farm gate price, payments will stop once the advance rate reaches the fixed milk price. Open Countries allows farmers to lock in up to 60% of their seasonal production. Payment structure differs from Fonterra. It provides cash benefits a little bit earlier. There are some new options coming out from Fonterra regarding the fixed milk price. Now, there's been a lot of things going on in the background about fixed milk price, and this is probably one of the reasons why Fonterra put an announcement out about an announcement. But as of June 2025, they are telling us that you will be able to have a fixed milk price for an additional season. So instead of just locking in for the 24-25 season, you'll be able to lock in for the 25-26 season as well. They also offer you a minimum milk price, which is obviously going to allow a farmer to get certainty. If you know you break even at $8.50, then there could be the opportunity to lock in a minimum payment of $8.50. They're also going to put in a minimum and a maximum price. Obviously, this is going to give you a bit more flexibility for you to pick exactly where you want to be in the market. And they're going to allow at this stage up to 50% of your production to be locked in in any combination of those three options. Milk futures contracts. Now, these have been around for a while, typically bought and sold through a company called Jardins. They're available through the New Zealand Stock Exchange. You can purchase a future contract at a set price per kilo of milk solids. They trade in $6,000 bundles via NZX brokers. Now, the problem or the issue that many farmers see with these is as the market changes on a daily basis, the farmer is either in or out of the market. Now, that means that in order to have these fixed milk contracts, you need a pool of money that is available to be pulled on or added to as the farmer is in and out of the market. Now, this is quite scary for banks and the farmer, and it's only really at the top end of town that there's been some playing in this market. Just recently, Fonterra and StoneX put together a product which really is an option for a put option for milk price. Now, put option allows the farmers to set a milk price which protects you against price drops while still benefiting from price increases. If the market falls below the strikeout price, the farmer sells at a higher price. The market price rises above the strikeout price. The farmer sells at market price. So that essentially what we're saying there is that if you lock in a put option at $8.50, if the payout drops to $7.50, you will still be paid $8.50. If the payout is $10.50, you will be paid out on $10.50. But in order to secure the put option, obviously you do need to pay a premium to StoneX for that. And obviously it is more akin to an insurance product. But the benefits of hedging milk prices, it does give you increased financial ability. You do know exactly where you are year on year. It definitely gives you certainty of cash flow. If you lock in $100,000 at $8.50, then you are going to get $850,000 cash in your bank. It probably allows for better budgeting and cash flows. You are at the mercy of the payout and the international markets for dairy commodities. And it obviously lessens the risk where you are again. At a certain point in time, you know what money is coming in the door. But obviously everything in life comes with risks and challenges. There is an increased opportunity cost. It does cost. Any of these products are costing you a premium. Even the Fonterra one is costing you 10 cents a kilo to lock in. As more and more of these products hit the market, and more and more of these products will hit the market, it's going to require a higher level of understanding and making sure that you as a farmer know exactly what you're signing up for and what you're doing. It does potentially increase the cost. Again, all of these products come with a premium. Like I said before, even Fonterra's comes with a 10-cent premium, and the put options from StoneX obviously also come with a premium as well, but that varies on what level of cover we are wanting to get. And obviously it's also a possible increase in commitment that is required from the farmer. Is it right for you? Every farming business is unique. Some farmers may not want to take the option. They're quite happy with the risk of the highs and the lows of the dairy industry. You've got to weigh up the benefits, the risks, and your financial goals. Yeah, and they are going to be very different. As you're talking to your neighbor over the fence, there's a very good chance that you both would take different stances on any sort of fixed milk price options. Professional advice will help you tailor a strategy that fits your needs. And then this is, again, every farm is different and you need to have an individual strategy in mind. We're obviously CMK Accountants. We are a rural-based accountancy practice firm based in Taranaki. We're here to help dairy farmers. If you've got any queries at all, please leave a message below or drop us an email or give us a call.